Welcome back, everybody. Today we are talking about cost, revenue, and profit, the three main reasons why you are probably in business calculus. Most of these things are pretty self-explanatory, but let's go ahead and give them a more mathematical sense so you can make more sense of this stuff with actual equations and hard numbers instead of gut feelings. First thing we're going to talk about is the cost. So the cost of producing an object is often related to how many are produced. So if you don't produce anything, well, you'll still have a cost of your production facility. So if you have a warehouse where you build things, even if you do not have anything getting produced at the time, you still have to maintain the building. So there is flat cost associated. These are often called overhead. But you also have costs that are associated per item, such as the materials, work hours, everything from there. In this class, we're going to note cost with a capital C. Now, we also have a Q. This is going to be used for supply and demand. Often we're going to use Q for being the maximum of the two. So let's look at an example for cost. We can say that our overhead cost would be $20,000, and for whatever we're producing, it costs us $20 per item to produce it. Now, how many of these items should we produce? Well, that's a tough question, but if you do market analysis, you can often find the demand can be based off the price of the item you have. So in this situation, you can say that the demand is equal to negative 0.06 times the price plus 84. That's convoluted, so let's just think about it for a moment. 84, well, that would be how many you could sell for free, which doesn't seem to make too much sense. But you want to keep in mind that if you end up having something for free, the only people who will take it are the ones who really want it, or just people who really, really like free stuff. If it's something that isn't that great, then they might not take it because it might just take up too much space. But what you can do is substitute the demand into your cost function and give you a new cost function, which is now based off of the price you charge for the item. Which, as you can see here, your cost will actually start going down as the price you charge increases. But you have to keep in mind that as you increase your amount of items you produce and increase the price, the amount of people who actually buy them goes down. So you have to keep that in mind. Now let's talk about your revenue. This is where you will actually make money. So revenue is often based solely on the number of products sold. You can still have overhead revenue, but that would be a situation of having advertisement. Such as at restaurants, you'll often see they have advertisements either on the tablecloths or on the placemats or something like that. That would be an overhead revenue. We're not going to deal with those for the most part, but those would work the same way as overhead costs, but you just add them to the revenue function instead of the cost function. Revenue we're going to be denoting with a capital R. And revenue, the easy way to put it, is the price times the quantity. So if you could sell Q of them and you charge $10 a piece, 10 times Q, and you're good to go. Now, here's why we see for revenue, why we use the minimum. Because if you have a supply of 500, but only 10 get sold, you're not making money on all 500. You're only making money off of 10 of them. So you have to use only the minimum. Now, you might be asking why we use the maximum when we were doing the previous one. Well, if people have a setup where you want 500 of them, and you don't produce that, well, you're probably going to be lucking out. But if you end up producing too many, well, you still have to pay for every single one you produce. So be careful of that. Which is why knowing how these two interact is very important so you don't cause a company to lose a lot of money. So let's look at this example. Let's go back to that same demand. Well, if we have our price, multiply that by our demand, we get this function for the price that per, then we get our revenue. Now profit. This is what most people actually care about. It's usually the difference between how much money you break in and versus how much money you have to give out. Which profit, P, is equal to R minus C. So your revenue minus your costs. Pretty straightforward. Well, let's go ahead and take a look at the equations we had before. So we had negative 0.06 P squared plus 84P was our revenue. Our cost is $21,680 minus 1.T2P, which will give us this profit equation, which, if you notice, is a quadratic. So we can find a maximum profit, which will be at our vertex, which would be $690, which, if this scale was in $10 tens instead of ones, that could be $6,886 in profit. You have to be careful about your units. I did not state whether P was in dollars, tens of dollars, millions of dollars. We don't know. You have to be very careful that you are consistent. So here's a couple of exercises for you to try. So newspaper has a fixed production cost of $70 per edition and costs 40 cents to print. And they charge 50 cents per paper. Write the associated cost, revenue, and profit functions. Also find the break-even amount. This is where the cost and the revenue are the same thing. Further, given the following notation, I want you to find a formula for the break-even quantity, which we're going to call BE, based off of the selling price per unit, the variable cost per unit, and the total fixed cost. So I will let you go ahead and pause the video here, and then continue on once you have tried these yourself and see how you did. I hope you've tried them yourself now, so let's go ahead and see. For the cost function, you should have 70 plus 0.4 Q, because it's $70 per edition, not per paper. And Q is your quantity, and it costs 40 cents to print it. Your revenue is 0.5 Q, because you charge 50 cents per paper, and your profit is 0.1 Q minus 70, which if you produce 700 papers, you're going to break even. All right. Now, did you get the break even is equal to your total fixed cost divided by your selling price, subtracting your cost? If not, look over your calculations, see how you did again, and if that still doesn't work, feel free to ask me when you get a chance. See you in class.